Good evening, everybody. We're getting some snow here in Pittsburgh, and I understand up north of here they're getting a lot of snow. Anyways, tonight we've got Greg Hughes. He's the managing member of Hughes Private Capital, LLC, and he's a portfolio manager for the ROI Strategies, LLC. He's raised over $70 million for his first trust deeds and equity for his real estate fund. And he's also the author of Excess Returns, Exploiting the Inefficiencies of Today's Real Estate Market with Lease to Owns. So anyways, I'm not going to take up any more of his time. Greg, nice to have you here at the Candlestick Forum, and we're interested in seeing what you have to present.
All right. Well, thank you, Steve, and thanks for having me on tonight. So welcome. I'm Greg Hughes, and I'm with Hughes Private Capital. I'm one of the co-founders of our real estate investment fund. And in the next 20 minutes, we're going to have a little bit of fun. We're going to cover also our proprietary real estate investment strategy. And we're going to keep it pretty short and sweet tonight as we cover this investment strategy, really at a very high level. And I'll give you some other ways to find out more about it at the end of the webinar here. So you're going to want to make it all the way through today because we're going to have a gift for you if you watch till the end. And sorry, it's not going to be a block wrapped in $100 bills, but it will be worth it to make it through the end. And like I said, it's only going to be about 20 minutes, and then we will open it up for questions. So, turn off your cell phones, lock the door, get rid of it at a time. So our strategy is simple yet powerful, and it's very different than what you might be used to for other real estate type of investing. Through our retail company, which is called My Lease to Own, we have built a proprietary lease-to-own strategy using single-family homes, and I want to tell you about two major advantages today with this strategy. So the first one is how our lease-to-own strategy absolutely crushes what we call an ordinary rental when you compare the two side by side. And I have a great visual to help you remember this. Plus, we said we're going to have a little fun here tonight. So, I don't know, but for some reason, it just makes me think about last year's Super Bowl. So, to me, this is a perfect visual of what an ordinary rental looks like. So, you with me so far? And now, here's the visual for what a lease-to-own strategy looks like. So, you know which one outperforms the other one. And sorry to all the Bronco fans out there in the audience. I hope there's not too many of you, and you'll forgive me for kind of making fun of the Broncos' loss from last year. But I'm trying to make the point of the difference between the two strategies. Simply when you compare the two side by side, lease-to-owns absolutely dominate. There really is no comparison at all. And what this slide is showing, and don't try to worry about reading all the stuff on there or everything. This is a little spreadsheet that we put together, and I'm going to actually offer this to you at the end of the webinar. If you'd like to get this from me, you're more than welcome. But what it does is you can plug in your numbers, see how it would look if you had a property that you did a lease to own, and what would it look like if you compared it to an ordinary rental. So our second big advantage that we're going to discuss is how our strategy has a built-in protection plan, and it's got a lot of added safety in there for our investors, even in a real estate downturn. And I'm going to show you how we accomplish this and why. But before we get to those advantages, I want to tell you a little bit more about our company. So we've been in business for almost 6 years now, and we've invested in over 132 properties. And currently we have $11 million in assets under management. And currently our return to our investors is 11.39%, and there's a $50,000 minimum investment to get into our fund. So, by the way, when you're looking at this graph, we're the blue line on the graph. And I just like to show people this because we have a very consistent return. In fact, we've never had a down month so far in the history of our fund, which is just a little bit over 5 years old. With our strategy, we're going to have some months that will have better wins, some that will have a little bit of a loss, but not much. It doesn't move a lot. It stays relatively consistent. And if you look at this graph, the blue line's us. We're just comparing ourselves to the Dow, which has a pretty good return at this point, but bounces all over the place as compared to something very consistent but a very low return like the 10-year Treasury bond. So just trying to show you that we have very consistent returns, but with a pretty good return overall. So as for our team, this is what we do every day when we get up. In other words, we eat, sleep, and drink real estate investing. And it takes this type of dedication to be successful. And that's exactly what our current team of 12 does day in and day out. And when it does come to lease to owns, I literally wrote the book on it, like Steve was telling you about before. And the name of my book is Excess Returns. And what I do in there is I lay it out. I take our strategy and I lay it out just like a blueprint so you can see what works and what doesn't work. And it's available on Amazon, but I'll tell you in a moment how you can get. So enough about us. Let's talk about why I named my book Excess Returns. Where does that come from? And let's talk about how our strategy outperforms other real estate investments. So what are excess returns? Well, it's the spread between our lease-to-own strategy in comparison to a similar kind of investment used as a benchmark. And you can probably guess it. We're going to use the benchmark as an ordinary rental because that's what everybody's used to and what most people do. So it's the spread between those two. What kind of returns can we get from them? So if we were to look at the benchmark, which would be an ordinary rental, we would have a cash-on-cash return about 5%. That's probably generous. Now, obviously, these can be all over the board depending on what you do, but we're going to compare one property and do it for both strategies. So I'm going to just use one property here as you see so that it's fair for both strategies. So roughly it's going to be at about a 5% return or so. What we find is that excess return is the difference between the lease-to-own strategy as compared to the benchmark, what we're using as the ordinary rental. So there's an excess return of 7%. And again, it's that spread in between, but that's a very large spread if you think about it. That's 140% high. And remember, again, we're using the same properties. You can see that on the bottom of the screen. It's just the spread between them. They're just different strategies for the same properties. Now, how does that translate into, dollars as compared to just percentages? Well, if you took a $100,000 investment and you compared the cash flow over a 5-year period, there's obviously a very big difference in the return. Once again, we're using the same home but different strategies. And after a 5-year period, you'd have earned 289% more with the lease-to-own strategy, or almost $54,000 more dollars in cash flow. So what's interesting is when we compare these two strategies, we not only end up making more money with the lease-to-owns, but we also have a lot less hassles with them. So let's talk about that next. I'm sure everyone here understands how ordinary rental properties work, including all the hassles that are involved that come along. Getting and keeping them rented, the constant upkeep and maintenance, and, of course, the never-ending expenses that go along with that. Not to mention the broken toilets, et cetera, et cetera. When you compare that to our strategy using our lease-to-own system, every one of those problems and hassles are all but eliminated. And I think at this point you're getting the message. Lease-to-owns don't just outperform ordinary rentals. They kick the snot out of them. And that's right, I just used the word snot in my presentation, so forgive me, but I really want to drive the point home one more time for you on that. So not only do lease-to-owns provide greater returns, but interestingly enough, they have less risk. So let me show you why our lease-to-owns are so successful. It really all starts with our lease-to-own homeowner. That's what we like to call them. And they have to go through a very extensive qualifying process. This is very important. I mean, this is like the underwriting, right? And we're very, very picky. We take only about one candidate out of about 200 that apply to our program. Now, we don't talk to 200 people. They go to application form, and most of them don't qualify at all, or they don't pre-qualify. But out of that 200, we probably talk to anywhere from 15 to 20 people. Out of those, only one of them will end up usually being accepted into our program. So what we do then to take them through the qualifying process is we send them off to a mortgage broker who then runs their tri-merge credit report. And he's going to come back to us with three things. He's going to tell us how much they qualify for in the future, when they can get their financing, and what type of credit issues they have. Now remember, they're not able to get the financing today, right? We're talking about the future. Now the reason why we're so choosy and why so few people get in is because we want them to have 100% chance of being successful within the 4-year period that we give them to buy their house back. Now we know they're not all going to be successful, but we don't let them enter into the program unless we know and feel sure that they have a reasonable, very, very reasonable chance that they're going to end up being successful if they follow along the steps that will help them to do so they can get the financing. And here's one of the most important aspects to our success. Once they're qualified, they get to go out onto the open market and they get to choose their own home as long as it stays within our guidelines. And our guidelines make sure our portfolio always remains in the core rental market. And what I mean by the core rental market is single-family homes that are priced at $250,000 or less, and they're in highly desirable. It's important in a moment. But before I jump past this this is what gives them the emotional buy-in. They've gone out to find a home of their own, and that's what's going to give them that emotional buy-in. Big part of why we're successful. So once that homeowner finds their home, we purchase the home for them, and then we set them up into a lease to own. And then something amazing happens. They actually become real people, not stick figures. Now I know that may seem a little silly, and we're having a little bit of fun here, but it really is true. This is getting people back to feeling like they're real people again and not just stick figures in the housing cog out there. Give you a quick story about one of our lease-to-own homeowners that was doing a video testimonial with us. And it still gives me goosebumps every time I kind of tell this story just because it makes me feel good about what we're doing. We'd been talking for about 30 minutes with her and her husband, but her husband kind of was on the quiet side. And she finally said, we were asking her questions. She says, can I just say something? Well, absolutely, you can say something. She says, we really felt like we were almost second-class citizens before we found your program. And now that we're in the house and we can walk through the neighborhood, we meet other neighbors, we tell them, yep, that's our home right down there, and they really mean it because that's their home down there. And on top of that, she said, I feel like there's doors that have been opened that we didn't even know were there. I mean, I'm sure they were there before. She just couldn't see them. And so, it's kind of stories like that make us feel really good. And we're very much the business people, and sometimes we forget about those parts of the whole story. So, and really we hear this in all different types of versions. Many times, at least on the home we're seeing, we literally were able to have a life-changing event for them. So, now part of that is because we also treat them like a homeowner, and this is, by the way, a very good metric to see if they fit into our program. So, really, the day they walk through, we try to treat them just like a homeowner. And part of that is they're required to pay for all the expenses. This is one of the ways that we make better money, and they're required to act and be a homeowner with us. So they take care of the property taxes, the owner's insurance, the garbage, the sewer, HOA fees, repairs, and improvements. And if they balk at that, then they don't really think and act like a homeowner. It's interesting. The ones that we've had a problem with there, we sense that they don't think like a homeowner, have become problems for us. So it's another one of our little ways of qualifying them. Most of the people that come in, they go, yeah, sure, yeah, I'm the homeowner, and that's the way it works. All right, now remember, we don't speculate or gamble on any of these homes. Since a homeowner's already gone out and chosen their home, They've also put down a substantial down payment with us before we purchase the home. And therefore, we also have cash flow day one. That's huge. And we really rarely ever have any vacancies. In fact, the only time we'll ever have a vacancy is if a lease-to-own homeowner were to walk away. A major advantage using our strategy and its built-in protection. So really the built-in protection is our contingency plan. And it's this: if any of our real estate markets were to falter, causing our lease-to-own homeowners to walk away, we would simply turn the homes into ordinary rentals, and we would wait out the real estate cycle until it recovers. And we know that real estate cycles will come back around and they will recover. And what we know is that single-family homes are always rentable when we follow our guidelines, as I've mentioned before, by staying in the core rental market. Plus, they will remain income-producing assets for us even during real estate downturns. People always need a place to live. Now, that's definitely not the same with vacant land or commercial buildings. I own both vacant land and a couple commercial buildings. At times, my commercial properties have had vacancies for even a long time, and it didn't seem like no matter what I did, could I get them rented out. And of course, vacant land itself is only an expense anyways, or for the most part it is. I suppose there's sometimes you could rent it out. But the one thing that we know is people always need a place to live, and if we structure these right with the single-family homes, they're always rentable. Now, I know I said before, there's less risk overall with a lease-to-own. Here's a chart that shows you some of the reasons why. So right off the bat, we have a much more highly qualified tenant than an ordinary rental. We talked about having cash flow day one. We're not buying a house hoping to get somebody in there to rent it up, you know. They will come up with at least $10,000 or more of upfront cash. That's a pretty big qualifier right there. They definitely have pride of ownership. They've gone out and found a home themselves. And they are responsible for all the repairs, and they perform the improvements. One thing I want to mention on improvements. We have many people that move in, and they do act exactly like a homeowner, and we allow them to do this, and they do quite a few improvements. In fact, some are very dramatic and have really improved the homes. And, you know, you just don't get renters that do that for you. And then the last part, as we talked about before, there's really no vacancy rate with a lease-to-own. And, of course, you've got to work in about a 5, maybe to a 10% vacancy rent on an ordinary rental when you're working your numbers. Now, a lot of people ask me, so say the market falters, then won't the rents go down? So what I did, I went out and I found 11 years' worth of rents to see, well, would that be the case or not? And it's really not. I always knew this, but I didn't have the numbers just in my head. People, like we said, always need a place to rent or to live. And so rents really are a laggard, and they follow way behind the pricing of homes. And in fact, looking at this chart, this is for the last 11 years, and I know there's a lot on there, so just look at the red line really for the most part. You can see that it's pre-bubble, it's the bubble, and then the bubble burst. And you can see that the greatest drop in the rent, hopefully you can see it because I know it's small, was under 6%. So it's relatively insignificant overall because those rents just do not follow the overall pricing of homes. Now, another way we're able to provide safety for our investors is really through our tremendous cash flow. And like we said, that's starting on day one. But that's a huge safety factor for our investors. But as you also know, however, we can't eliminate all the risks. But yet, ironically, when you think about it, our fallback position of having to turn our houses into ordinary rentals is really where most investors only start. And I mean, even thinking about like the big guys, even like Blackstone. So these are the things that we know. We know pretty much our upside. We have, for the most part, very predictable downside. And we know we can always rent them out and they can be income producing. And because of that, we like to call them a sustainable rental. If we really had to go back to doing that, we would hold on to them, they're sustainable, and we would make it through that real estate cycle. So it always makes me want to kind of ask this question, why start with an investment that's already our contingency plan? Well, from my point of view, I don't know why anyone would, but we're very used to this, and that's what we do in the real estate investment space out there. So, or maybe you say, hey, I want to just skip all this. I want to stick my money with just 100% safe bet, or almost 100% safe bet, a CD, or like I affectionately like to more call them, a certificate of disappointment. I went out and searched for the best 5-year CD I could find from a national bank out there, and I found one at 1.59%. At that rate, you're not even staying up with inflation, and you're losing buying power every day. But I'm really assuming that there's not anyone on this webinar at all that is interested in just keeping all their money in a CD. So let's talk about the ways that you can invest into this lease-to-own strategy. So there are 3 methods that people use to invest with us, and you can do the same, obviously. You can do it as an individual, you can do it as a trust, and you can use your IRA, which is a great way to go. We're going to just talk briefly about that in a little bit, and then I've got something for you on that at the end of the webinar. But before we're getting close to wrapping up the presentation. I told you I was going to keep this short and sweet. We'll do some questions here at the end because I'm sure there will be some. But the one thing we need to talk about is being an accredited investor. A lot has changed in our world with the Jobs Act back in September of 2013. And the only way that we can take somebody into our real estate investment fund at this point is they must be an accredited investor. And so we do have some investments for people that are not accredited, and I'll tell you about those on the next slide. But let's just talk about what an accredited investor is. So accredited investor is somebody that has $1 million in net worth, excluding their primary residence. Or, so you don't have to have both of these. Or you could have an individual income of $200,000 or more. Or if you do it as joint, you can do it you have to have $300,000 or more. Now, there's a few more little things in there, like you need to have the $200,000 or $300,000 for the last 2 years. But that gives you a nice summary of what it looks like to be an accredited investor. And so we used to be able to take in non-accredited investors into our fund, but now we're not able to do that. But what's so great is we're now able to go out and talk to people about it. Before, we had to have a pre-existing relationship. I wouldn't even be able to be doing this webinar with you here today if that had not changed. So we're giving up a little bit, but we're getting a lot on the other side there, that we can actually now go out and tell other people about this. And as long as they're an accredited investor, they're able to come into the fund. All right. So there are 3 ways to invest with us, whether you're accredited or not. You can invest in our fund. And like we said, you have to be accredited on that. And we can get into all the detail if we get down to that point. You could also buy individual properties. We could do lease-to-owns for you. You could hold the title. Some people like to just do it that way anyways. You don't have to be accredited to do that because you wouldn't be coming into the fund. And then we also have just a fixed rate of return option for people that want to do that. And in that case, you don't have to be accredited either. I can give you all the extra detail if that's something that you're interested in when we get down at the end of the webinar. All right. For any of you that want to use your IRA to invest, definitely ask us how. It is super easy to get set up. We can help you. We have multiple investors in our fund using their IRA to invest. It's an absolute great way to go. Now, we are not a custodian, so we're not the experts in that field, but we know a lot about it. And, of course, what we would do is get you to one of the good custodians that we know out there, and we can refer you over, and you can follow up with them. All right. Well, we've reached the end. I've got some cool stuff for you. The way you can find out more about us is you can go to lease2ownstrategy.com. They're up at the top. Or you can call that number, 877-404-7171. Either way, you can get the stuff that I'm going to talk about. Here we have a possibility of over 400 people on this webinar tonight. So unfortunately, we just can't give a book to everybody, but we're going to give a free gift out to the first 50 people, an autographed copy of my book, Excess Returns. That will be sent to you in the mail. And like I told you, it lays out the strategy that we have here. It's just like a blueprint, gives you a very in-depth look at all the details. And then, plus on top of that, you'll receive an investor kit in the mail, and that's going to include a sample capital statement, so you can see that, a tear sheet, which is like a summary of our fund. And then we have an excellent white paper on how to use your IRA to invest in alternative investments. And then we'll place you on our list for our investment newsletter, which will be just automatically sent out to you and keep you up to date. And then, like I told you, the spreadsheet, really, it's to take it, that you can take it and compare lease to owns side by side with ordinary rentals, which is kind of a fun thing to do if you're into that. So we will send all of that stuff out to you. So we've reached the end, and I appreciate your time, and we can turn it over, and I will take questions if there are some. So I'm looking to see if there are any questions. What are the areas that the homes are in? Yeah, I didn't mention anywhere that we're doing business. So we're based out of Reno, Nevada, and so we do them there, and we also do really more down in Las Vegas. We have some that are up in the North Dakota area, in where the oil fracking is going on. We're very cautious up there, but we make so much darn money up there right now, it's kind of hard to ignore. We're in the process of opening up right now in Phoenix, and we were just down in Dallas about 3 days ago and looking through that area, and that's looking very promising. We think it's important that we continue to find other areas and to diversify the fund itself. Average price for the homes is probably in the $200,000 range. It depends, again, where you're talking. Reno's a little bit more expensive than Las Vegas, so Vegas is probably closer to about $180,000. Reno being around the $200,000 or so. Is this eligible for Canadians? Yes, it is, and we have not yet had a Canadian invest with us, but we have a couple that have been kind of watching us and participating with us as we've gone along. So, all right. Could you elaborate how exactly the lease to own works as far as what people pay and how long the lease is? Yes. So, detail-wise, it's a 4-year lease. They come in and they put down 4% down payment that's credited towards their purchase. They're going to be putting down a first month's rent and a security deposit. And then, so roughly, the easiest way to say this, although it's not exact, is they're going to pay about 1% of the value of the home for their rent. So $200,000 home, they're going to pay about $2,000 a month. Out of that $2,000, they get 20% of that as what we call rent equity. So the rent equity is going to go back to them, and they get to use that when they purchase a home towards their down payment, towards their closing costs. If they have extra money left over, it will actually reduce their price on that. And then the way that we work the pricing for them, all this is set up in front for them. We're very, very careful about this. We have lots and lots of paperwork, probably too much, but we want to make sure that they know what's going on and that there's not a big question down the road or surprise. So and this changes every so often, but when they buy a property, whatever we purchase a property for, it increases to them at 14%, and that's for the first year, and then each year thereafter it goes up 2% more. So as investors, we're making our money on some of the rent and the cash flow, and then we're making the other portion on the increase on the price itself. So let's see, another question, who sets the criteria for being a certified investor? Well, that is the SEC. So that's done through the government agency, and we don't really have any choice on that. I would say that they've picked sometimes arbitrary numbers, to say the least, and I don't know or understand exactly why. But with the new Jobs Act and the new way that we have to do it, we actually have to do exactly what you're asking there. You have to become certified. So, and it's actually relatively easy as long as you have the criteria to make it happen. You would go see your accountant, you can see a stockbroker, you can see an attorney, anybody that's a third party that will vouch saying, yes, you are a certified investor. They're going to want to see, the paperwork behind that too. So if somebody wants to do their own property through you, are we limited to the areas you're in? For the most part, yes. It doesn't mean that we wouldn't talk to you on that, and I'm not sure exactly what you mean by your own property. In other words, I'm assuming you're saying the property that you own itself, and whether or not you could do a lease to own through that. That's a possibility. That is, we've found, I got to tell you, we found it difficult if you own a piece of property and to get somebody in there to go with just that piece of property to come in there. So it can be a little bit of a challenge. Hopefully I'm answering your question there. Does your fund qualify for a 1031 exchange? I don't think so. We've looked into that, and I'm just not sure that that's a possibility. The reason is because you would be coming out of a like type investment. And again, I'm not an expert in this, and you need to go in that like type investment. So, and I think the reason why it won't is because you're coming out. Let's just say you've even been in a single family home. You're going to come into an LLC, because when you go into the fund, you're buying a membership within that LLC. So I'm assuming that it won't, but don't hold me to that, because maybe there's a way of doing that. We get asked this question all the time: are you compliant with Dodd-Frank? And the answer is, as far as we can tell, yes, we are. Just got done answering this a bunch of times when we were down in Dallas. We were at a conference there. We don't do seller financing, so we don't fall under that part of it. We actually talked to an attorney that was part of that bill, and he basically told us, look, it's a gray area, like almost everything in the law, and he felt that we were compliant with that. So remember, we own all the properties, and this is not seller financing. So, is your investment fund simply an investment vehicle and leasing the homes a whole other separate investment opportunity? No. Again, hopefully I'm understanding your question here. The investment fund itself is the investment vehicle, and then it holds all the property. So I basically think of it as a holding company. Our main company, Hughes Private Capital, is the operating company. That's where all of our employees are and all that. Our fund, which is the name of our fund, is called ROI Strategies. ROI Strategies is really a holding company, and so it holds all the properties that are in there, and so the leases go through there. Now, we have to have property management for that, so sometimes that's outside of that. Most of the time we're doing our own property management, but sometimes we have to pay somebody else to do that. So it's a holding company. It only has expenses to it attributable directly to the homes themselves. So if the owners qualify with you, why wouldn't they be qualified for a mortgage? Good question on that. And, a lot of people sort of get this mixed up. In fact, we even have people that call in and say, well, we don't like your program. We're just going to go get a mortgage. Well, if you can get a mortgage, then we want them to get a mortgage. It's going to be a lot less costly for them to do that. The whole reason why they qualify with us is, let me give you just a really good example on this, is you got people that come through here that have had a short sale. They maybe never missed a payment in all their life, but at this point, they just had a short sale and they're not able to get financing today. So, they're almost a perfect candidate. So they're maybe 2-3 years off, depending on when they came into the process and when they had their short sale. So that's a perfect example. They've been a homeowner before. They're not interested in going out and being a renter, and they want to own a home again, and they don't want to have, or they do want to have the control and not be a renter. And this varies all over the place, but for the most part, they just can't qualify for a regular mortgage, whether it's conventional or FHA or whatever it may be. And so they have a time frame that they need to come in, and then they can qualify with us because we can see the light at the end of the tunnel for them. And like I said, we don't let them in unless we see that light and we know that it's relatively reasonable that they're going to be able to be successful, because that's what we're most interested in. I understand your rent setting practice. I assume you handle repairs, etc. How much do you charge for managing the properties? We charge 10% for managing the properties. We don't really handle the repairs. When we set up these deals with our lease-to-own homeowners, they handle all the repairs and they handle all of the improvements. Now, I have to put a condition on that, right? We have literally a tenant-landlord relationship with them. They have an option to purchase from us in the future. If they were, I'll give you an example, they were to call us up and say, hey, our hot water heater went out and we can't afford to repair it, or we don't want to repair it. Well, by law, we have to provide them hot water. That's an essential, aspect of having a good rental property, and it's required by law. We go in and fix that hot water heater, and then whatever that cost was, that would get added on to their option when they're ready to purchase. So that's a way that we make sure they're always taken care of. That happens very, very few times. It's kind of amazing how little it ever happens. What happens to the funds if the person doesn't buy the property? So they've come in and they put a down payment down, and they've also collected rent equity over the period of time. So if they do not purchase a property, then the investors get to keep that side of the deal. So that was their consideration to actually purchase the property. And it's obviously they're very much incentivized to do that. We've had, I think now at this point, out of everything, 93 or 95 homes. We've only had 5 people walk away, and that's been in the last 2.5 years. So very few people have been walking away. We've had 16 people purchase, actually maybe 17 at this point, I think, coming up this month. So, okay, what happens in 4 years when the tenant refinances you out and the value of the home appreciates is less than your anticipated 20% appreciation? Do you lower the price? Well, we could. That's a possibility. Here's the legal answer. The legal answer is we don't have to. We've already struck the deal with them, and if it does not appreciate for that amount, and let's say that they're not at the end of 4 years, they could do a couple things. They could wait a little bit longer, and hopefully it would appreciate more for them. Obviously, only going up 2% a year for the last 3 years at the end of the deal would be better for them. Or they could bring in more money. Or we could decide that we would sell them that property for a lower price. That is a possibility. But legally we don't have to. And it also goes the other way. If it's gone in and the house is worth more than whatever they have to pay us, then good for them. They got an extra good deal. But we all went into it eyes wide open and knew what we were doing. Bob, I can't answer your question there. I don't know what happened to Steve. So he told me earlier that he was having some electrical problems, and he thought he would be back on here. So hopefully I'm doing a good enough job of keeping everybody on track here. So now, let's see. All right, so Steve is closing the barn doors. So whatever that means, shoveling snow. I guess there's a bunch of snow back there. All right, what's the price of the house? What is the price of the house is worth 50% of today's price 4 years from now? Well, we're going to be some pretty sad investors, you know. Obviously, none of us can predict that, and we don't expect that to happen, or we wouldn't be doing that. But if you think houses are going to be worth 50%, 4 years from now, I would definitely stay away from housing. There's no doubt about that. I mean, we could certainly turn our houses back into ordinary rentals, and we could rent them out, but that would be a big loss, and it would take us some time to get back out of that, as you can imagine. So, all right, I'm not seeing too many more questions coming through here. Or I'm just answering them faster than everybody can type. Is the investment minimum the same in an IRA? Yeah, because our $50,000 minimum is the same going into the fund, whether you're doing it as an individual, you're doing it through your trust, you're doing it through an IRA. So that's our minimum to get in. You know, would we maybe do a little bit less than that? Possibly, but we would like to be able to see that as an investor, you're going to be able to put more in overall. On IRA money, is this a trustee to trustee transfer? Okay, so I'm going to try to answer this again. I'm not the expert on this, and I'm not 100% sure on your question here, but I think this is what you mean. So I'm going to say it this way. Let's say that you have your money in your IRA in Charles Schwab, and you're investing into a mutual fund, to use that as an example. You decide to take that money out, and you want to now put it into what will actually become a self-directed IRA, is what it will be called, and it will go to the other trustee, which will be the custodian for that self-directed IRA. And yes, you would move it from Charles Schwab to that other custodian that would be the self-directed IRA custodian, and you would just transfer it from one to the other. One of them, Charles Schwab, doesn't allow you to invest into an LLC, where this other custodian would, and so that's the big difference there. And then they make sure, of course, you don't get in any kind of trouble in advising you on how that you can actually take that IRA money and do that and keep all your tax benefits along with that. All right. You're welcome, Ed, on that. More than happy to stay here and answer any more questions if there are some. You bet. Thanks, John, for letting me know. All right, well, I guess because Steve's gone, I'll wrap it up here today. So thank you, everybody, and hope to hear from you.